Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining me this Tuesday afternoon, we have Shawn, Cruz, manager of trader services at TD Ameritrade, to discuss Nasdaq-100 performance trends in the Nasdaq Volatility Index, or what we call VolQ. We'll also take a look at some other areas in tech as well. And Shawn, it's great to see you again. Welcome back to Trade Talks and Happy New Year. But I think really the Nasdaq-100, at least to kick off the year, is going to be the index to watch as we start to have this narrative of growth versus value, and Nasdaq-100 having somewhat of a volatile December. So let's take a look at your first couple of charts here and some fresh levels to watch.
Yeah, happy New Year to you as well, Jill. And I think the market was it looked like they were ready to come back from break as well. So you've seen some pretty volatile trading, and not only has it been volatile, but when you look at the internals of the markets, even yesterday when we had a pretty strong day, there wasn't this strong breadth where it looked like there was a lot of conviction behind some of the moves we're seeing. And I think this tells you there's just going to be a lot of positioning going on to start the year as we're trying to grapple with what does the rising cases of COVID that we're getting right now, what does that mean, and how long should that really be a major impact on the economy? What's the Fed going to do? What's their approach to policy tightening going to look like as we move into the year? So when you look at the one factor that really has the biggest impact on our growth expectations, and the other factor that has a major impact on our rate expectations, if those two sort of up in the air, I think it makes sense you're seeing some of this volatility. But looking at the levels we're at, I'm just looking for some consolidation right around here. I'm keeping an eye on that 100-day moving average to see if that holds. I think that might be a good barometer to watch. I think if you're looking at the RSI, you're not really seeing it get into overbought or oversold territory right now. So it looks like a little bit of consolidation here would be a good base for us to build moving forward and get a little choppiness. And if you look at VolQ sitting certainly off of some of the lows we had seen over the course of last year, but certainly well off of those highs as well. It's just telling you to expect a little bit of volatility, but I don't think it's saying anything it just suggests we're all clear for a run up higher, but also it's not really flashing any signs of caution that there's really anything right now that the market thinks is going to cause a massive pullback or put us into a bear market or anything like that. This to me is just a market that you should expect some choppiness, which traders enjoy, because that creates a lot of opportunity.
And let's talk about the SOX index for a moment. Of course, the semiconductor index. And as we know, the chip shortage has been a part of the broader supply chain constraints that we've been discussing. And just about everything that we use these days requires some sort of a chip or multiple chips in it. So what are you thinking about there with that index?
Yeah, and I think it was interesting. I was just watching something going over the industry in general, and they said, look, your refrigerator probably has quite a few chips in it, whether you realize it or not, and it's probably going to have even more in it moving forward for the future refrigerators we're going to get. So imagine what that means for some of the other areas out there in the electronics industry. The chip makers, though, they've had a pretty decent run up. I know some of these names are running into a little bit of choppiness, but the overall demand backdrop still looks to be solid. So I was looking at the Nasdaq 100 day and sort of looking at some of the individual names, and it didn't really see it. There's a couple red spots there in the semiconductor space, but really if you're looking at where a lot of the weakness is right now, to me that really stands out, it's in the IT space, the information technology sector, but really focused in the software space. Looking at companies like Atlassian right now is having a pretty tough go of things. There's a few over in the consumer discretionary, but I'm really going to be keeping an eye on some of these software companies in the NASDAQ to see if we can get some sort of a slowdown and some of the pullbacks we're seeing, and maybe a little bit of a bid coming in here. That can be a stabilizing factor for the index overall.
It's so funny you mentioned refrigerators. I was in Home Depot, and I think it was Samsung. On one of the panels on the fridge, it has what looks like almost a Tesla tablet where you can store recipes, and it looks like an iPad, Tesla kind of setup on the refrigerator itself. So to your point about chips being in things that are, more random than you would think of. But let's wrap up and talk about the 10-year, because we've been paying a lot of attention to that and what was happening with rates and how it relates to Nasdaq 100 companies.
Yeah, and I think the reason a lot of people have been focusing on the spread and be it the 2 versus 10s, the 2s versus the 5-year, but I'm really just looking at the 10-year yield in particular. One, because we're coming up towards an important psychological level around 1.7%, but it's not always necessarily the level that we hit on that 10-year yield, but it's really how fast we hit that. If it's a little bit of a slow grind higher, I think that could be less disruptive, but if we skyrocket higher, that's the sort of thing that can induce volatility around a lot of these high growth type of names. The one thing I think you want to focus on though is really as we move forward, what are we hearing from the Fed? What are we looking at in terms of the pace of tapering? And then once you're done with tapering, the pace of rate hikes. And that's still something that's up in the air. We got 3 new members on the FOMC. That lean a little bit more hawkish to the hawkish side of things, but I wouldn't call them hardcore hawks who are going to be pounding the table to raise rates. But I do think a lot of the volatility uncertainty for the 10-year moving forward is going to be something you want to keep an eye on, because that to me is going to be where the fallout from anything the Fed does in terms of economic impact will probably come up in the longer end of the curve. If you start to think the Fed's behind things, that's going to maybe upend our growth trajectory. Anything like that will probably show up in the 5 to 10-year yields and not so much on the shorter end. So that's why I'm keeping an eye on this 10-year.
All right, Shawn, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.